Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey, welcome back to the Financial Purpose Podcast. I am your host, Dale Shafer. This is episode 88. We are racking them up quickly. Today is a continuation of last week's episode. We're breaking down each of the letters and stages of the BOSS method, which is the financial planning process for business owners at lifemoveswealth.com. And, or I can say it another way, it is the process at lifemoveswealth.com for financial planning for business owners. Or I can say it another way, it is the financial planning, whatever, you get the point. Anyway, phonetically, however, it needs to be written. This is what we do for business owners, and that's the point. So today we're going to spend time on the O, which is optimize. Last episode 87, was dedicated to the B, which is build. So today, optimize. And as a refresher, the BOSS method is a two-way acronym. So the process stands for the business owner strategic success. It's the financial planning methodology that we use, but it's also a acronym for the stage of which we're operating with the owner through the business financial planning process. And so there's build, optimize, secure, and succession. And those are the four stages of our work together. And just like your business, the stages are not linear. And so sometimes we might be working on things that are in the secure or even in the succession bucket, and we have to bounce all the way back to build, or we have to bounce back to optimize because something in the business changes, or something in your life changes, or there's something directionally that looks different than when we started. You could have an up year, a down year, whatever. There's a lot of different factors. So business journey is not linear. Financial planning is not linear. The BOSS method is not linear either. And that's really important because owning a business is a lot of fun. It's very challenging. It's a lot of work. It's hard work. It's heavy work at times, because as the business owner, you get all of the perks of owning the business and being in control of the cash flow and deciding how fast you want to grow the business, how you want to grow the business, how many people you want to have working with you in the business, helping you to grow the vision and all of these things. But you also get all the restless nights and the personal guarantees and the debt payments and the payroll stress. There's a lot of risk involved with, everything that you do as a business owner. I mean, for a lot of us, our businesses start with a lot of our personal assets and money and financial wherewithal and our credit scores. Everything is on the line. I mean, we risk everything to start this business. It's not for the faint of heart. And so where the BOSS method comes into that is most financial advisors focus only on your investment accounts. They talk about the markets, they talk about the economy, they talk about the account type, they talk about what the investments are doing, how they're performing, what the risk metrics are, what your time horizon is, what your Sharpe ratios are, your Sortino rates, like all these things, right? Investment nerd stuff. And I say that I'm pushing up my imaginary glasses. That's what they focus on, and it's sexy, and investing is fun. And there's a lot of kind of quick hits when you're an investment advisor. But as a business owner, I know as an advisor also that the largest asset that you own is not an investment portfolio, typically. If you've been in business for a long period of time and you've saved a lot of money because your business has provided the ability for you to do that, maybe this looks a little bit different. Maybe you have a large investment portfolio, but most of us don't. The business is our investment portfolio, and maybe some real estate, and maybe some other assets and things like that. And yeah, we probably do have some sort of 401k set up or a SEP IRA or something And if you're running a business and you don't have something set up for you to save into, we need to talk, because you need to be diversifying your wealth, because typically the business is going to represent anywhere from 50 to 80 or so percent of your total net worth. That's a lot of asset concentration. And so we're going to need to work on diversifying some of that by saving money into other vehicles, or by going and looking at real estate for you if you tend to prefer real estate over market investments. I'm going to say that's an and discussion, which means we should have money in as many different asset types as possible. So that way you're not at the risk of losing everything if one thing goes south, or if the market has a down year, or if we have a recession and the business doesn't do as well, right? We want you to be able to have some financial independence by having different types of assets. So if that's the case, most advisors can't and won't advise on asset location or diversification, because it takes money out of the investment portfolio, which means they can't manage it, which means they can't charge a fee, which means they're probably not interested in talking to you about it. So at Life Moves Wealth, because we recognize business owners don't just need traditional investment advice, you need a fully integrated strategy. It needs to align your business activity with your personal financial planning and vice versa. And it's going to give you some financial clarity that can often be hard to have as a business owner. It's a step-by-step process that we use to optimize cash flows, do some good tax planning, protect your personal assets, protect the business assets, create an exit strategy that actually will work for you and for your business, and allow you to go on to your next stage, allow the business to continue beyond you. We want to reduce owner dependency in the business. And so the BOSS method is a framework that is designed exclusively for business owners who want to maximize their business and personal wealth without the misaligned advice that typically comes in traditional financial advice models, or typical stockbroker type compensation structures, or typical advice that includes, we're going to buy these mutual funds and these life insurance products and these annuities. Those things are good, but they may not be what you need as a business owner at every stage of your journey. So the BOSS method is going to help us do that, because we have a transparent process. We don't bill on the percentage of assets under management. It is a transparent, flat, fixed fee for the services. You can find out more information on this if you go to lifemoveswealth.com. In the menu, you'll see advisory fees, and you can see how that's structured. But all of that's good. Today, we're going to talk about optimize in the BOSS method. And so in the stage of optimizing, or optimization, or optimize in general, we're going to work on several key areas. And so the first one is going to be implementing financial systems that improve profitability and efficiency in the business. Now, profitability is a bit up to you as the business owner, how you run your business, how you're pricing your products, how you're negotiating with your vendors for the cost of the inputs for your widget or your service or your inventory or whatever you have. But where we can help with some of the profitability is looking over those things, understanding how you're paying your invoices, how you're receiving your payments, how you're paying your employees, how you're paying yourself as the business owner, the timing of when you're making these payments. Go back to, I want to say it was like episode 78 or 79 when I had Abron Villegas on, and we talked about the importance of understanding your working capital. We're going to do some work on working capital. And so I'm going to look at things like, what's your accounting method? Are you on a cash basis or an accrual basis? We're going to talk to your CPA and bookkeeper to make sure that you're on the correct cash recognition system. For most people, it probably should be accrual. That's my personal opinion. If you're running your business on a cash basis, there's probably a good reason why, and hopefully somebody has directed you to do that. If it's just what you picked, maybe we need to look and see if there's a more efficient way to run your business, again, based on what type of business you have, how you're receiving revenue, when you receive it, that kind of thing. I already talked about working capital. We're going to work on that. We're going to, I prefer to use the profit first methodology. It tends to be very helpful for how you receive money and then how it gets dispersed to other accounts based on the job that every dollar has. Some dollars need to be put aside for taxes. Some dollars need to be put aside for owner compensation. Some dollars need to be put aside for debt payments. Some dollars need to be put aside for future profit payments. There's all sorts of things that we want to do. So we want to give the correct dollars, the correct jobs, and have things set up so they're automated, so they're easy, and so that they work in helping you manage and just be very fluid and efficient with your cash flow. And we're also going to talk about business cash reserve because there is something to be said. I talk a lot about in personal financial planning, you want to have a personal cash reserve target, and you're either building toward that target or you hit that target and we need to start assigning dollars over that target, other jobs, or we need to invest them. So for example, some people set their personal cash reserve target based on a number of months of expenses or a number of months of income. I usually say that a number of months of income often means that there's too much cash sitting in a savings account, which can be very inefficient for how you're using money. So sometimes it's helpful to say, I want to have 3 months of expenses or 6 months of expenses. If your income fluctuates heavily, maybe it's 9 months of expenses. Maybe for some people, you just say, yeah, I mean, I've thought about the last handful of emergencies that I've had. And so, if I have $20,000 in the bank, I'm comfortable. And then everything else can be invested. For some people, that number is 50,000. For some people, it's 12. You'll find the right number for yourself. That's part of the questions that we answer in the personal financial planning process. It applies in the business as well. And so you want to think through what would happen if we have a down month. How much money would I need to make sure that I can make payroll? I can pay the lease on the building. I can pay the bank loan for the business loan. I can pay the utilities, and we can buy inventory and still make sure that we're able to go out and produce revenue. Whatever that number is, if it costs you $50,000 a month to run the business or $32,000 a month to run the business, you might want to have at least that much in the bank account or a multiple of that amount in the bank account that's sitting aside, that's in a reserve bucket. Now, whether or not some of that money is invested, we can talk about that. Those are all important questions, but it's important to have a minimum cash reserve for the business because there will be a point where the well will look like it's running dry, whether or not it does, and you may need to draw on those reserves. And it's way better to have money sitting aside that you can pull on if you need to, rather than having to go out and quickly borrow that money or take work you don't want to take just so you can get a little bit of revenue coming in. So the business cash reserve is going to be very important. And a part of that is understanding whether or not your business actually runs on a budget or some sort of financial projection, or are you the kind of business owner who's making decisions based on what the bank account balance looks like in a given day or a given week or a given month? We want to know how you're operating. Are you operating on target? Are you operating, do you set goals for the beginning of the year and then you never look at them again until the end of the year and you go, oh, hey, let's see how we did? Or are you only looking at sales numbers and not paying attention to everything else? We're going to want to know that because if you're not looking at everything else, we need to set up a KPI dashboard for you. We need to know your key performance indicators, which ones are important for your business. Go back to episode 80, where I talk about key performance indicators and how to build out your own key performance indicator or KPI dashboard. Some businesses are going to want to look at different things, so it's important that you understand which factors matter most for your business. And then you don't want to just get a report card on these things. You want to know how you're doing so you can drive the numbers to where you want them to be. And so it's important that you're going to set targets for those numbers, set ranges of health. And so you know that if you're profit margin target is 12% or 35% or 52%, whatever your margin is, if you're at, let's say your profit margin is 35%, that's your target. And there are people who will listen to that number and they will say, no business should be making 35%. Hear me out. You're not going to make the 35%. You're going to actually probably make less because there's going to be things that you're going to have to pay for. But you need to have a target, and a business absolutely should be able to run a profit, and it should not be a crime. And please send this to any of your friends who say that businesses should not make any money, or that they should make a 5% margin, or they should only be allowed to make 10%. Go ahead, send it to them. I will argue that until I'm blue in the face. A business should have the freedom to profit as long as it is providing a service that the marketplace wants, that the marketplace is willing to pay for, and that it adds value to somebody's life. That's it. There may be some other minor criteria there, but the business should be profitable, and you need the business to be profitable so that you can do other things like pay your people and give them cost of living increases and invest in the future of the business and invest in future growth and to expand to other product lines and to give money into your community and to sponsor Little League tournaments and Rotary events and boys and girls clubs and things like that. You can't be the good in your community without profit. You just can't. And if you don't believe me, go find out how much good your local government's doing on their own. Yeah, business can do better, my opinion. But anyway, we want to know those things. So again, going back, if your target profit margin is 35%, let's say, and you're at 30%, are you in range or are you out of range, or is that a panic moment, or is there a lever that you can push to move the needle back to 35%? So you want to have a target. If it's 35, is our drift between 30 and 40? Is it between 32 and 37? So you want to know what that looks like, and then you want to be able to track it so you can make adjustments throughout the year, not get the report card at the end of the year and then realize that you left money on the table, or you missed opportunity, or you're not making profit because somebody's stealing from you inside of the company. That happens a lot. Or you're overpaying fees for something, or you're overbuying inventory that you don't need that's now sitting on the shelf that now needs to be discounted to move it. So you want to track these things throughout the year so you know how to run the business along the way. As we're doing all of that, one of the key important things to watch is our expected tax liability. So we're going to do some proactive tax planning, both on the personal and the business side. And that's going to look like things that might look like things such as understanding your business entity structure. So are you in the right entity type for the type of business, for the amount of money that the business is making, for the future goals of the business? So for example, if you're the type of business that wants to go public and you want to be able to raise capital from outside investors, you probably shouldn't be an LLC. You probably shouldn't be an S Corp. We may need to make you a C Corp. If you're never going to raise that much money and your business is never going to earn more than $1 million of revenue, you probably shouldn't be a C Corp. We ought to look at making you an S Corp, right? So we want to make sure that the tax structure is in place. If you have multiple partners, that's going to be an important decision for how we set up the entity as well, because there's going to be multiple tax implications for the number of people that have to be paid. And then how are you doing those distributions and under what time? And by the way, if you have multiple partners, do you have an operating agreement that spells out how this is supposed to work? And what happens if somebody dies? Or what happens if somebody wants to be bought out? Or what happens if you want to bring a partner in? Or what happens if the business grows beyond a certain level and you want to divvy up shares differently? Or what if somebody gets divorced, right? So all of these things need to be understood and documented. And as your advisor, I need to know these things, because if something does happen that triggers one of those what ifs, I need to bring it to your attention if you don't bring it to mine first. And we need to be able to have a conversation about it. And then I need to be able to say, you know what, we need to get your CPA on a phone call now. Or, you know what, we need to schedule a meeting with the business attorney or the estate planning attorney pretty quickly. We need to handle this risk exposure. We need to understand how all of those things impact your exit goals and not just your taxes. But we also are going to want to look at, because we're talking about being tax efficient, we're going to want to look at ways that we can reduce tax liability. And sometimes it's through simple things that are good for the business and good for the employees, like setting up a retirement plan or bringing in some other kind of benefits, healthcare benefits, vision care benefits, some sort of disability coverage. Maybe you're going to get them prepaid legal, like all of these things that you can give the employees as a perk or as a benefit. Those help offset business tax liability. And so we're going to want to look at those kinds of programs. One of the other things that we're going to do that is very important, and this actually, it's in the optimized bucket, but it often gets done really early in the process, which is, I want to know, because I'm going to ask for your business financials, I want to know what business owner personal expenses are being paid through the business cash flow. I want to know that because I talked last week about having add backs. I want to know what those are. Those are going to impact your profitability. They're definitely going to impact your tax. And in fact, most business owners who are paying personal expenses through the business do that to reduce their tax liability. What they don't know is that along the way, they're also reducing their business value. And so we want to clean up the books. We want to take business owner personal expenses, and they either need to be justified as a legitimate business expense, or they need to be pulled out of the business cash flow and paid personally. And that's where we need to have a conversation of, does the business need to pay you as the owner a higher salary or a different dividend strategy or distribution period, or how you're taking owner draws? Do we need to increase your income so that way you can pay the personal expenses correctly? Or, because we're going to do your personal financial planning as well, is there a budget issue or a cash flow issue on the personal side that needs to be cleaned up also? So we're going to look at those things. And again, if a personal expense is not a legit business expense, I'm going to ask you to stop doing that. Because it's not healthy for the business for you to do it. There are compliance issues, it's add back issues, it hurts your valuation, it hurts your profitability. When you go to borrow money for expansion or to get a line of credit for the business, or sometimes even just to get a credit card limit increase for the business, or even just a business credit card, they're going to want to see P&Ls. And if you're driving down your profit number, it's going to look like your business doesn't make any money. And so it's going to be harder for you to get access to capital and investment. So it's very important that we're doing this the correct way and that you're running the financials clean, very clean, squeaky clean, and you're not commingling personal expenses with business cash flow. And then we're going to work with your CPA and your bookkeepers to make sure that everything is in the right categories on your P&L, that we are receiving the revenue correctly, that we are running expenses correctly, that the business activity matches what you need to be doing throughout the year to manage the tax liability. We don't want to be surprised. We don't want to find out on March 14th how much money you're going to have to come up with on March 15th to pay a tax bill and then to extend your tax return until September 15th or sometime in between when the CPA does taxes over the summer. We want to know what the forecasted tax liability is going to be throughout the year. And the only way to do that is to do ongoing tax planning, to keep track of the business activity, to understand ways that we are able to reduce the liability throughout the year rather than just draining money out of the business so we don't pay taxes. We don't want to do that. And then the next and final kind of big rock within the optimized stage is we're going to look at asset protection. We're going to do some good risk management. And that's usually going to look at things like How are you insured? What's your liability coverage? What's your risk exposure to any kind of liability or lawsuit or patent infringement, right? All these kinds of things. What are your legal safeguards? What happens if something happens? Do you have an operating agreement? Is it updated? Do your bylaws, if you have them, or your operating agreement, are they current to the way you're running the business now? Do you have the right coverages for insurance? This is a place where a lot of people take shortcuts. They underinsure themselves because the risk exposure isn't going to happen to them. And it usually at some point something happens. And so you need to make sure you have the right coverage for errors and omissions, or for board and officers, for business liability, even simple things like somebody trips coming into the door of your office. That's a liability exposure. If you're sending people out into the field to do service work, think landscaping, painting, garage door repair, any of these number of services where somebody leaves your shop and goes to someone's home, the drive between there, you're exposed to liability, because if you have branding on the side of your vehicle and your employee is in a car accident, you look like a really good lawsuit target just because you're a business and surely you must have money. So you want to make sure that you're protected there. And then if somebody's working at somebody's home or somebody's, business, or other residents or something of that nature, there's liability risk there. So have the right coverage in place is going to be very important. We want to make sure that the business has an emergency response plan. So, for example, if there's a fire or a tornado or a hurricane or a flood or something catastrophic like that, a strong windstorm or a tree falls through the building, can the business continue to operate through those periods where you have something out of your control? And again, as the owner, what happens if something happens to you? What happens if something happens to a key employee? What happens if something happens to your only working crew? What happens if your truck or vehicle or service van or whatever is in an accident? How are you able to continue to produce revenue without that asset, or without that person behind the wheel of that vehicle or something like that, right? So you always want to think through these things, have a plan in place, for in case something happens, you have a backup plan, and we can immediately operate here. We can change course here. We can work remotely from our homes, right? So what happens if another pandemic comes, God forbid, and they shut down our economy again? What happens, right? Because I think we're all out of that mindset now. Nobody's thinking about what if this happens again. We need to be thinking about what if this happens again. We need to be thinking about what if some country who we just dropped bombs on decides to send bombs our way, right, on missiles or some. You need to just think about these things because there's too many factors outside of our control. We need to know what that's going to look like. So that's the O in optimize. Again, it's all working around cash flow, emergency preparedness, risk exposure, tax efficiency. Those are the big rocks inside of the optimize. And so maybe you've heard this, you're a business owner. Maybe you know somebody who is a business owner who should be hearing this. Please make sure that this gets to the right people, because at Life Moves Wealth, if you haven't figured out already from listening to this episode and the episode on the build stage, we do things a little bit differently than the average financial advisory firm. We think about our clients a little differently because you're not, as a business owner, like the average investor. The average financial advice platform and fee structure and operation is not built for you as a business owner. It's built for the average investor with large investment accounts that advisors can charge fees on and give advice around and sell products to. That's not you. You're not the average investor. You need a financial advisory relationship that considers your business as your asset and knows how to help you manage that asset, diversify that asset, and make sure that at some point you can have an exit from that asset, or exit from that asset that will be profitable to you. Just like any other investment, we want to make sure that you're able to get out at a high point, capture as much value as you can, be tax efficient along the way. And we do all of those things not the day that you're ready to sell, which is when most advisors want to get your phone call. Hey, I just sold my business for $50 million. Do you want to manage it for me? That's like every advisor's dream phone call, right? I want you to be managing the process along the way so that if we know that your business value is going to be high, that a couple of years before we have made sure with the other professionals that we need to bring into the conversation that you have the right entity type for how you want to make the transition, that you are tax efficient and tax prepared, that we have the right accounts set up for you based on how we want to distribute that exit and what's going to be most tax efficient, that we have the right CPA in place who understands that we're all working as a team, the advisor, the attorney, you, the potential buyer, if you're going to go to market or if you're going to sell to your management team, or if you're going to do some sort of transition plan to a key employee or a family member, or you're going to sell the business to a charity. There's all sorts of options for how you do this. We want to have a plan in place so that you're not searching for a financial advisor to do a dog and pony show the day after you sell the business. We simply will have a plan in place. The transaction will occur. The money will be wired to your account, and boom, we're already executing the plan of your exit strategy. And so we do things differently than the average advisor. It's going to sound different than whoever you're going to bump into at a networking meeting or at church or at your college reunion or your buddy's advisor or your golf friends or somebody at the dinner club or the country club or the restaurant or wherever you're hanging out. We do things differently than the average big firm advisor who wants to charge a percentage of whatever money they manage for you. They're going to sell you stuff. They're going to say, hey, when the business sells, we'll deal with it then. We need to be dealing with it long before. So the reason that I do it this way, and the reason that I put the boss method together is because the more that I work with business owners, and I'm working with a lot of business owners these days, more so than the average investor. And I have clients who are average investors and they're perfect. I enjoy working with them. They have great challenges in how they're running their life and their careers as well. We do things a little differently for our business owner clients. And as a business owner myself, the more that I pursue my business goals and some of the growth and diversification that I want for myself, beyond just my investment accounts, I realize that we just have different needs and we have different risk tolerance than a lot of people because we're willing to put any part of the anatomy that you want to suggest, we're willing to put it on the line to make the business grow. And we're willing to guarantee it. And we're willing to put our home equity up as collateral. We're willing to put our bank accounts up as collateral. And we're willing to take all the risks that we need to take appropriately, sometimes too much risk for some people, to make the business work. The average person's not going to do that. And there are less, as a percentage of the population, there are less business owners than there are anybody else. And so you just need different advice. You need wealth management that aligns your personal financial health with your business financial health and helps you run them together. Because if your financial health as a person is suffering, the business is going to suffer because you're going to need to be sucking all the cash out of it to fund your lifestyle, and vice versa. If your business is suffering and not profitable, you're going to be hurting as an individual on the personal side. And so we want to tie those things together so that way we know what each one's doing and that they're feeding each other, not sucking each other dry, right? That's going to be very important. So business owners need more. The boss method is designed to solve a lot of those challenges and give you the financial clarity. It's going to give you control. It's going to give you more confidence that both sides of your financial life, personal and business, are indeed working together. Both are healthy, and they're working together toward the same goals. And it's not just another financial planning process. It's not just another marketing acronym. You know, it's not. It's none of that. It is firm action It is an actual step-by-step process that we take, and it's going to put you in control of the financial future. So we're halfway through the year. We're right at the end of June here. There is still time to make 2025 the year that you take control of your business and you take control of your personal financial health, and we tie them together. You can reach me at info@lifemoveswealth.com, or you can go right to lifemoveswealth.com and click the schedule time with me button. I'd love to talk to you. I understand you as a business owner. I speak your language. It's going to feel different and sound different than any other advisory platform that you might have talked to or intersected, or even you might have an advisor right now and they're not talking to you about any of this stuff on your business. If that's the case, you probably want to get a second opinion, and I'd love an opportunity to work with you. So go to info@lifemoveswealth.com, send an email there, or go to lifemoveswealth.com, click the schedule button, and we'll get started. So I hope that's been helpful. That's the O and optimize. And next week, we're going to talk about the strategy bucket, which is a lot of fun, because that's where the strategy part of that is securing the business. And that's after you've been running it for a few years and things are starting to get stable. We have the foundation built, we have the cash flow aligned, we have the tax planning going. And so now everything's going to be about how do we start to reduce owner dependency? How do we start to diversify your activity and your asset and all those things? That's going to be a great conversation. So I hope you come back for it. In the meantime, until the next episode, go be a boss. Take care of yourself. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.